So let's begin with chapter 6. The name of this chapter is Accruals and Prepayments. So first, we need to understand that to calculate the profit or loss for an accounting period, we need to make sure that all the income and expenditure incurred in that accounting period need to be recorded in the same accounting period, irrespective of the fact whether the payment has been made or not. So this is what the concept of accrued and prepaid expenses tells us. So as you can see here, it says that the income earned should be subtracted with the expenditure incurred to arrive at the final profit or loss. Again, keeping in the mind the fact that all the income and expenditure which are incurred in one particular accounting period need to be included in the same accounting period. So if the figure is positive, then the entity makes a profit, but if the figure is negative, then it is a loss for the entity after you subtract the income from your expenditure. So let us understand the concept of accrued expense. So accrued expense arises when the expenses of the business of the current accounting period, it has been incurred but not yet paid for at the end of the financial year. So in simple terms, this says that the expenditure you have incurred it, but in the future you need to make a payment, and as of now there is no payment made for the same. So it says that if the expense is incurred in that particular period, the expense should be recorded in the same particular period and not when the payment has been made. So in future, obviously you will make a payment and money will go out of your business. So the accrued expense therefore reduces your profit, and this accrued expense will appear as a current liability in the statement of financial position of a business, since you are obliged to pay for the expense that you incurred. You didn't pay it in the current accounting period, but then in the future you have to pay for it. So that is why it will appear as a current liability in the statement of your financial position. So what you will do in terms of journal is, you will debit your expense account and then you will credit your accrual account in the statement of financial position. So let us understand this with a small example. This says that a business entity is preparing its financial statements for the year ended 31st December 2011. So they've listed all the financial heat and light expenses for that period, which is in Feb, May, August and November, and the bill received on 28th Feb says that 450 for the period of 1st December to 28th Feb. So December, Jan, Feb, 3 months. That bill particularly is paid in November. So what we will do is, as you can see on the debit side, they've listed all the expenses for the appropriate months, but for the December month, you still have incurred the expense for that particular period, but you need to pay for it in the future. So we will use 450 divided by 3 and then list the 150 amount here, because the expense was still incurred in December, but you will have to pay it at a later date for 3 months, for a quarter. So this is how 1/3 of the expenses represents that the amount applicable to the month of December. And then you will add all the expense and list it in the statement of profit and loss. So this is quite simple. So this is how they've mentioned the journal account of heat and light, and then your accrual was carried down of 150, and then it will be brought down in the next financial year. So let us look at prepaid expenses. So prepaid expenses, from the term itself, it is quite obvious that the expenses are prepaid, which means that it is prepaid in advance. So what it says that a prepayment arises when the expenses of the business have been paid in advance or prior to the year end. So whatever expense you need to incur in the future, you've already paid for it. So you've settled that expense in advance. So prepaid expense scenarios a lot of time comes when we go through transactions in our real life as well, right? Suppose you have a prepaid phone card where you pay the amount of your telephone bills and your SMSs in advance, and then you take up the service later. So you pay the amount and then you take up the service, which means you've prepaid for your expense. Similarly, when it comes to airline tickets, we book our tickets and then we fly at a later date. So that is prepaid. So that is exactly what this is about. Even in an entity, they prepay some expenses and then take benefits of that in future. So this will be considered as an asset to us because we already prepaid for the expenses, and this will increase our profit since the expense was already paid. So here we will debit our prepayment account in the statement of financial position, and it will appear in the asset side of the balance sheet, and we will credit our expense account. Looking at an example for this, it says that the business entity incurred these expenses and it pays rent quarterly in advance. So the rent is paid quarterly, and the annual rent for this period was 4,800, but it was increased to 6,000 per annum with effect to 1st December 2011. So the accounting year end is December. So what happened in December is that the rent was increased. So for all these months the rent will remain same, which is 1,200, but for December we will subtract we will just divide 6,000 divided by 4, which is 1,500, because that is already prepaid as an increase in the rent. So the prepayment of the same will be credited because it will be an asset to us, and we will add the total of the same, which has to be appeared in the statement of profit and loss. So the next topic is accrued and prepaid income. So when it comes to accrued income, this is quite simple. It says that this income has been earned but not yet received. So it is also very important to record this kind of transaction, right? So you've earned the income but you've not yet received. So to understand this, mutual funds would be a very good example. So mutual funds accumulates whatever returns they have, and then the investors are paid only once in a year. So all this time they are just accruing the income, but they've not yet received. They've earned that income but they receive it only once in a year. So that is exactly what accrued income is. So this will obviously increase your profit because you've earned that income, and it will be an asset for the entity. So you will debit your accrued income account in the statement of financial position, which is it will appear on the asset side, and you will credit your income account in the statement of P&L because it is a gain. So accrued income creates an additional current asset in the statement of financial position and an additional income in the statement of profit and loss. So to understand this with an example, it says that a business entity earns bank interest of $300 per month, and during the year ended the bank interest of $3,000 has been paid. So if it earns $300 per month, then we will just multiply it by 12 to calculate the annual interest, which will be $3,600, and the amount received during that particular period was $3,000, which means you've earned the $600 but you've not yet received it. So that part of it is accrued. So in the accrued income side, we will record $600. Coming to prepaid income is something when the income has been received during the current accounting period, but it relates to the next accounting period. So it is exactly the opposite of accrued income, which means that you've received the income but you are yet to provide the service. For example, say a tenant of yours who wanted some part of your office has paid rent to you in advance, but it was for the next accounting period. So you've received your income in prepaid, but you are yet to provide the service, or you are yet to oblige to provide the service. So next month you need to make sure that the office space for the tenant is kept empty, since he had already paid the rent for the same. So this will be a liability on your end, right? Because you are yet to provide or fulfill that obligation. So this will automatically reduce your profit, and it will create a current liability in the statement of financial position. So your entry will be, you will debit your income account in the statement of profit or loss and you will credit your prepaid income, and therefore this will reduce your profit. So to look into this with an example, it will be a business entity rented out a property to a tenant at $5,000 per month. During the year ended, it received $64,000 from the tenant. So the tenant paid $64,000, but your monthly income is $5,000 per month. So we will just multiply this with 12 and the entire rent will be $60,000, but the tenant, he paid us $64,000. So what was the income which was prepaid? It is quite simple. It was $4,000 because the income earned was $60,000 but we received extra. So the extra amount here is $4,000 and that will be considered as our prepaid income, which will appear in the current liability of the balance sheet since we are yet to provide the service to the tenant. The next part of this chapter is the application of accounting concepts, and the application of accounting concepts talks about the matching concept and the revenue recognizing concept. So as we've already seen that in the first chapter, this is just a repetition of the same. It says that the period of the accounting period is matched with the statement of profit and loss with the expenses incurred in earning that revenue. So the fact that something has been paid for during an accounting period does not necessarily mean that it has been consumed. So you need to fairly adjust that in relation to the transaction. Again, another important concept is the realization concept, which says that we recognize revenue when it has been earned and not when it has been paid for or when cash is received from the customer. So additionally, it cannot be recognized until it is measured reliably and it is probable that the future economic benefits are going to flow. But once you recognize revenue, it has to be for that period and not necessarily when the cash has been received from the customer. So that is what these two concepts try to explain us. Next, we will just go through one example. It says that rent paid on October to December was $1,200 and rent paid between October 2013 to the December 14 end was $1,600. So what will be the rent showable in the statement of profit and loss? For this period, for $1,200, it will be for about 9 months. So we will just calculate 1,200 into 9 by 12 and we will add it for a period of 3 months between October to December because the statement ends in 2013, right? So that will be $1,300. So once we add that, we will receive 1,300. So this is what this illustration tries to explain it to us. The final illustration says that the transactions on the electricity account for the year ended 30th April were as follows, and it says that what are the following appropriate entries for electricity in the financial statements for the year ended. So we will make a journal account to understand this and we will record all our electricity expenses in the electricity account as they've mentioned here for June, September, December and March. And then it says that electricity accrued at May 2015 was $250, but only a part of that will be paid in April, which is about $150. So in May we will add that and then we will bring it down to the next year, and that is how your statement of profit and loss account will be adjusted. So for this reason, your statement of profit and loss will have 1525 as their balance, and the electricity carried down in April will be about $150. So the correct answer is option B.